Let's talk about one of the most commonly used phrases in real estate investing: institutional quality. It sounds impressive, it signals safety, stability, and strong performance. However, here is one often overlooked question in that context: does institutional quality actually mean a better investment? In my experience, not always. And in some cases, it can lead to opposite outcomes. Let me explain. When people say institutional quality, they're usually referring to assets in strong markets, newer properties, prime location, high quality tenants. Those are all positive attributes. But here is what often gets overlooked: these assets attract the most attention: institutional capital, private equity, family offices, basically large check writers. Everyone wants the same deal. So what happens in those situations? Competition increases, and when competition increases, pricing becomes more aggressive, cap rates compress, and as cap rates compress, your margin for error shrinks. While the asset may be high quality, the investment may not be, because you are paying a premium for perceived safety. Now, compare that to a slightly less competitive segment of the market. Still strong fundamentals, but less crowded. Tertiary markets, for example. In those cases, you may find better pricing, better yield, and more room for value creation. So the goal is not just to invest in quality assets, it is to invest in assets at the right basis. And that is a key distinction, because returns are driven by what you pay, not just what you buy. Now, this does not mean institutional deals are bad. Not at all. They can actually perform quite well, but they're not immune to risk. And they're certainly not guaranteed to outperform. Here is how I think about it: separate the asset from the investment and ask the following questions: am I paying a fair price that allows for downside protection? Is there enough margin to absorb changes in the market? Or am I relying on everything going right? Because the biggest risk in high quality deals is overconfidence. Protecting your capital is not about buying what looks the safest. It is about understanding the relationship between price, risk, and return.